Hello and welcome back to The Note. Emerging markets are cheap. We know that, and we also know that they are cheap for a reason. But are there some opportunities to capitalise on value? Well, one very interesting possibility is to look for dividend yield and the protection it offers, not an area that is often associated with emerging markets. With me now to discuss this is the portfolio manager for emerging markets income at JP Morgan Asset Management, Omar Negyal. Omar, thanks for joining me today. Let's start by taking a look at one very basic picture, which is that both earnings and dividends per share in the emerging world have radically outperformed the developed world over the last decade or so, but that they've plainly eased off in the last few years. Where do you see this pattern heading?
Well, I think you're absolutely right that the long-term trend has been very, very positive in terms of both the earnings and, crucially, the dividend per share trajectory from emerging markets. But over the last couple of years, it's been a bit more of a struggle. And we can see from this chart that it's been more difficult to grow the dividend. I think that's primarily been a function of cyclical headwinds that companies have faced. Some people are worried about big structural problems in emerging markets. We don't see those. We think it's primarily a cyclical issue, which has been exacerbated by some of the currency weakness that we've seen in emerging markets.
Okay, and in terms of that investment cycle we've seen, if we take a look at the next chart, we're seeing how high dividend yield stocks do relative to the others. As emerging markets have gone out of favour in the last few years, so dividend yielders have gone out of favour within the emerging markets really quite dramatically. Why is that?
Well, I think this chart is pretty striking. There's two things that it shows. Firstly, emerging markets has not participated in the same kind of reach for yield which we saw in Europe and the US. Right. So you can see that it never really got to those levels in terms of the difference of high-yielding stocks versus the average. And actually, it's been derated in the recent past because investors have become more fearful. They've become more fearful of emerging markets in general, and that's been even more seen in the higher-yielding stocks in emerging markets. So they've been looking for certainty, and they haven't got certainty today.
Now, there could be some explanations for that, right? I mean, high dividend yielders tend to be utility companies, energy companies, which will often be formerly state-owned, privatised, and ghastly monopoly companies in various countries with poor corporate governance. You could also argue that a high dividend yield is a sign of lack of quality. So how well supported are those dividends? Is this really a quality or a value strategy?
Well, I describe dividend yield in emerging markets as a quality value strategy. Right. So clearly the value comes from the yield side itself. The quality, because I think a focus on dividends and sustainable dividends is a big part of it.
Okay, let's just quickly take a look at some balance sheet crunching numbers here. So the payout ratio is staying fairly stable, and as you're saying, the net debt to equity looks very, very impressive.
Yeah, so if we just look at that, firstly the red line, the dividend payout ratio, and you can see that over time it's been actually very stable in emerging markets. In the last few years, it's been around just over 30%. It shows that companies are willing to continue to pay dividends to shareholders even through tougher times. So that willingness to pay, I think, is a pretty supportive point. It shows there is a sustainability around the dividend policy in emerging markets. And then secondly, the ability to pay. Company balance sheets have improved over time. The gearing levels have come down. Lower debt levels suggest the ability of companies to pay dividends going forward is better now than it was in the past.
Okay, so this is a very interesting case. Where does this strategy take you? Which countries are you overweight? Which countries are you underweight?
Well, from my point of view, ultimately, it is all about the stocks. We need to find the right individual companies that can sustain a dividend where we see strong returns on capital and where we have some trust in the management to deliver to shareholders. But there are certainly areas of the emerging world that points us to. Some of the areas we're really interested in today are Taiwan, South Africa, Turkey, and Saudi Arabia.
And are there any particular sectors?
Yes, from a sector viewpoint, telecoms, which some might see as a natural place for dividends in any asset class. We're also very interested in consumer discretionary and the industrials area.
Okay, thank you very much indeed, Omar. This is a very interesting topic. People plainly see that there should be an opportunity developing in emerging markets. The question is how to take advantage of it. Theoretically, as Lex has been saying, as I've been saying for many years, dividends shouldn't matter. In practice, it's plain that they do have a very big effect on investment outcomes. Looking for yield in emerging markets does look like a very interesting strategy.